Begin. So good morning and good afternoon. Welcome to Treasury Strategy's quarterly cash briefing for the UK, Eurozone, and North America. And we're very excited. We have over 1,000 attendees who signed up for this cash briefing from over 40 countries, so truly global. And welcome, everyone. I am Moni Lindsay, Managing Director in Treasury Strategy's London office, and I'm joined on this call by Tony Carfang, Partner of Treasury Strategies. We're excited today to be joined by our panel, whose organizations also sponsored this event, Martin O'Donovan from the Association of Corporate Treasurers here in the UK, Debbie Cunningham from Federated Investors, and Roger Merritt from Fitch Ratings. I will provide further background on our panelists before the panel discussion. A bit of background on these briefings. Corporate liquidity has long been a significant aspect of our consulting work for both the corporate and bank customers of Treasury Strategies. We began these briefings and the research behind them several years ago to understand at a deeper level the story behind cash hoarding that was continuously in the press. So we began tracking the central bank quarterly reports of cash levels from the Bank of England, the European Central Bank, and the Fed, and we've also added Switzerland and Japan. We've continued to formally and informally survey and have one-on-one discussions with our corporate clients to better understand drivers and plan changes around cash levels and the management of cash levels. Today, we're pleased to share with you our latest findings and join our panel in discussing the implications of the continued myriad of economic and regulatory changes. A word before we get started. Our 45 minutes today gives us no time for live Q&A. However, we want to take your questions, so please type them into the question box in the bottom right-hand corner of your screen, either during or at the end of the webinar. We'll circulate the answers to all who have called in. A quick preview of the next 45 minutes. Tony's going to share the latest reported cash levels. I'll review key highlights from our recent survey of corporates. Tony will then provide an overview of potential game changers and the financial crisis timeline as a background or backdrop before we head into our panel. Then we'll introduce our panelists and have our panel discussion. And then finally, Tony will share the advice we're giving our clients, and I'll wrap up. So Tony, let's get started. So what are the latest reports from the central banks telling us?
Well, thank you, Moni. The central bank reports are actually telling us quite a bit. We have quite a bit to talk about this morning, and just want to point out to all of our listeners here that we are at the 5th anniversary of the financial crisis, and part of what we want to do this morning is take a look back to remind ourselves actually what had happened. It's easy, particularly as we read all the articles and the retrospectives on the financial crisis, by reporters who weren't there. Many of us on the line today were there, and we ought to remind ourselves of what really happened and what problems we're trying to solve with high cash levels and with regulation. So with that, U.S. corporate cash is now $1.8 trillion, and that's actually flat from quarter to quarter. Last quarter was also $1.8 trillion, but as you can see from the upper left-hand graph, the trend is still sharply upward, and no signs of backtracking whatsoever. As we talk to our clients, it's very clear that cash has become almost a hedging instrument, where cash on the balance sheet is a buffer against unforeseen risks, as well as a buffer for questionable future availability of credit. And that's true globally, not just in the U.S. Now, in the U.K., cash quarter over quarter was up 2.3%, up to 531 billion from 519. The EU, the Eurozone cash levels were actually down by 2%. So, all in all, it's pretty flat. And Moni will later on go into a substantial amount of detail about what's actually happening in the flows underneath these totals. On the next page, I think we have some an interesting trend to show here, where Actually, going back since the year 2000, cash levels have pretty much doubled. We're indexed to 100 in the year 2000 there, and we're up to about 240 in the UK, 210 for the Eurozone, and right about 200 for the US. And while there's been a little bit of divergence, it hasn't been a lot. Corporate cash has been increasing pretty much by region. And as you see on the next slide, since June of 2000, corporate cash in the U.S. has grown from 9% of GDP to 11%, Eurozone 14 to 21, which is the number we've actually been reporting for the last several quarters. So the trend seems firmly in place. The UK did a substantial downward revision last quarter. We have yet to get a complete reconciliation of what happened, but based on the new revised numbers, UK corporate cash has gone from 23% of UK GDP in June of 2000 up to 33% of GDP at the end of the last quarter. One of the things I'd like to focus on today is what's going on with balances, with reserves at the central banks. As you all know, the central banks have been involved in some dramatic quantitative easing programs, stimulus programs, and we're seeing a lot of money being pumped into the economies worldwide. As we step through these, though, we actually think that there are some interesting stories here and perhaps an ominous warning about flows around the world. If we start at the top left, reserves on deposit at the U.S. Federal Reserve Bank hit $2 trillion at the end of the second quarter, and just this morning we were able to see some mid-September numbers that show us now north of $2.2 trillion. So the torrid pace of expansion of the reserve base is well apace. Keep in mind that prior to the second quarter of 2008, 5 years ago, only 5 years ago, total reserves in the U.S. were $40 billion. That's billion with a B, and now we're over $2 trillion with the T. Now, the Fed has talked about tapering, reducing the scope of its bond buying, and ultimately thinking about how to unwind its portfolio. And if we listen to the pronouncements that came out of the Fed the last couple of weeks when they decided to reverse course and not to taper, they still seem to believe that they will be fairly much in control of the ultimate wind down of this huge base of reserves. We're going to get back to that in just a second. But first, next, we want to move on to the Bank of England, where the reserve levels are actually down a little bit from the prior quarter, but relatively flat over the last year. Now, in the bottom center chart, we see reserves at the European Central Bank. And what we see is a sharp spike upward beginning in June of 2011, peaking last year at about 900 billion euro and now dropping off to 400 billion euro. Last quarter, we talked about this before the latest big drop, and so some of the thoughts we had were that this was repayment of the LTRO, which would account for some of this, but not a huge part of this. As we research the literature, the Financial Times seems to quote European Central Bank officials anonymously as saying, well, this is a result of economic growth in Europe, and this is a good sign. That doesn't seem plausible based on other factors, but that's what they said. We have another take. At Treasury Strategies, we were looking at this pattern and we're trying to figure out what the heck is going on here. How do you go from 200 billion to 900 billion down to 400 billion? And we said, have we seen this pattern before? And it's kind of interesting, and we wonder if we actually showed this chart to a regulator but took off the title that said ECB, and if we were to say something like total assets in prime money market funds, the regulators would say, oh my God, and we're in the midst of a huge run right now, 500 billion euro run. and then we'd obviously turn around and tell them, well, actually, this is you guys, and you really can't regulate yourselves out of business. It's interesting, if we overlay this with the total assets in prime money market funds from 2007 through 2009, we get a very similar chart, except that the increase and the decrease for prime money market funds were not quite as steep as we see here for the European Central Bank. And what we saw back in 2007 was the asset-backed commercial paper markets, the offshore rate securities markets, froze. All of those assets moved, wholesale into prime money market funds, and then during the financial crisis, left prime and moved into Treasury funds. But almost an identical chart here. It's fascinating. Now, I want to go back up to the top left chart where we show the balances at the U.S. Fed and the Fed thinking that it is in control of monetary policy and can unwind. We actually took that $2 trillion and were able to find another set of statistics that broke that number down further, and we have a proxy, which is cash and reserve balances on the balance sheets of U.S. banks. And using that proxy, it looks to us as if of this $2 trillion number, which actually as we see it today is probably north of $2.2 trillion, based on the Fed's own statistics, about 30% of these reserves are from what the Federal Reserve calls large domestic banks. So these are the big U.S. banks. 14% are from small domestic banks. And fully 50% of this number is in a category that the Fed calls foreign-related institutions. I have to tell you, it looks to us like fully half of the reserves at the Fed are reserves placed there by non-U.S. headquartered banks, which certainly raises the or challenges the notion that the Fed would be in control of the unwinding of this, since half of these come from outside the U.S. Not sure what this all means. Again, our objective here is to put some ideas out to you and get your reactions. We'd love to hear your reactions to these charts and the hypotheses about what's going on at the Fed and the ECB in particular. Now, just to wrap up, we see reserves at the Bank of Japan shooting skyward, which is exactly what we predicted last quarter after Bank of Japan announced its quantitative easing. When we look over at the Swiss National Bank, we actually see it's been fairly flat. And it's interesting that it flattens right at the point where the exchange rate hit a target that the Swiss National Bank had set for itself. So and if currency markets remain stable, it looks like Swiss National Bank monetary levels will stay at about the same level. So that's a lot about aggregate cash levels and reserve balances. I'm going to turn this back to Moni, who will discuss what we actually are seeing and hearing from our clients.
Thanks, Tony. So let's turn to what our clients are saying. We recently went out to our clients via our LinkedIn groups and conducted a short survey of 5 or 6 questions regarding their current and planned practices and expectations around their cash balances. Now, note we did receive several hundred responses, and they were global, much like the attendees on this cash briefing today. So also note that we've been doing this long enough that we're now able to share with you year-on-year results, starting with September 2010. So a general comment is that about the survey results is that the dramatic changes we saw in behavior and expectations after the crisis has really leveled out, with most companies having achieved the levels of balances, working capital efficiencies, and maturities and risk appetites having achieved really where they want to be. But let's see what the trends that emerged with this survey are telling us. And so on this slide, we're pretty much seeing that the rate of increase in companies expecting levels to increase has really slowed, or it's about status quo. So not a lot of change from a year ago. But now let's look at the sources of cash. So if you look here, sources. The sources really remain concentrated in positive cash flow from operations. So we saw a nice increase from 78% last year to 82% this year. And continued reduction in inventories, but not as dramatic as we saw, again, post-crisis. And if we look at the next slide, it's just a nice graphic illustration of what we're seeing with the sources. Again, hugely concentrated in positive cash flow from operations. Again, reduction of inventories right after the crisis, as most companies were really looking to working capital efficiencies to free up some cash for them and be a source of cash. And then if we look at the next slide, we'll see how cash is being used. Capital expenditure is pretty much steady with a year ago. There's a continued decline in negative cash flow from operations, which is a positive sign about the economy. And then there's slight increases in pay down of short-term borrowings. And not a lot of dramatic changes in the others as we look at those. And again, the next slide will just show us a graphic presentation of the uses of cash. Again, the most dramatic thing here, again, capital expenditures are a huge source of cash, but then the negative cash flow from operations, use of cash, and then the negative cash flow from operations, which is a huge use of cash in 2010, and that's declined dramatically. Then in terms of managing risk, which is on the next slide, maturities are really about as short as they're going to get. So it's hard to imagine companies really taking their portfolio shorter. And generally on risk, companies are really where they want to be. So we're not seeing a huge change. So if you look at credit risk, the past 6 months, 30% were more conservative, but the next 6 months, only 11% expect to be even more conservative. So again, companies are pretty much where they want to be. And then, and always interesting is looking at expected changes in Treasury management. Continued reliance on forecasting and focus on forecasting, again, as companies are trying to make sure they have access to the cash they need to have access to. So there's been a huge focus on forecasting since the crisis. And then the implementation of new technology. Again, September 2010, we saw 43% focused on this because after the crisis, everyone realized they needed the technology in place that helped to give them the visibility to and ability to manage their cash balances. There continues to be a focus on implementation, but that's leveled out as many companies are already where they really want to be, but continuing to look at their technologies. And then, again, we saw a lot of companies really look at their investment and risk policies right after the crisis and make changes there, and that's leveled out as well. So let's look at what some of the clients are saying. And really the comments have echoed the survey results, but what we see is that cash remains a conundrum, particularly for companies that want yield, and with phrases in these that really talk about what a task that is. So they call cash or managing cash like walking a tightrope. Managing large cash balances in this environment is a losing proposition. They say it's critical to be mindful of counterparty exposure to banks. So we see that with our corporate clients, trying to manage and having in their policies how many balances, what levels of balances they can leave with each of their banks. And then this other quote that said we expect cash to remain at the levels they are for at least another 3 to 12 months while they target appropriate investment opportunities. So again, companies aren't getting the yield that they want, but they recognize the importance of having the balances as insurance, but also until they can figure out what the best investment is for those balances. So Tony, what are the potential game changers we're seeing?
Well, the game changers seem to be changing every day, Moni. There are 5 that we've highlighted here. Changes in monetary policy at the central bank, where we've experienced, particularly the U.S. Federal Reserve Bank, suggesting that it was about to cut back its $85 billion per month of bond and mortgage purchases, only to reverse course at its last meeting and put that off for an indefinite period. You know, what the Fed does, obviously, you know, it's the 800-pound gorilla here, impacts the market significantly. Moving around, clockwise, sovereign debt is back in the headlines again, and this time we're talking about U.S. sovereign debt. As you all know, October 17th is the date that the U.S. Treasury Department expected the U.S. to bump up against its debt limit, which means that it would not be able to borrow amounts greater than authorized by Congress. It was interesting, you know, that there has been talk in the U.S. of the executive branch, the Treasury Department, actually issuing additional debt beyond the congressionally authorized debt limit under some interpretation of the U.S. Constitution that would give them the authority to basically maintain the viability of the U.S. currency. That certainly hasn't been tested, so what we did was we did our own test. We went out to our LinkedIn group, our Financial Services Regulation group, and the conversation is still going on there, so feel free to go out to Financial Services Regulation on LinkedIn and participate. And we asked the question, a very simple question. If the U.S. Treasury were to issue debt in excess of amounts authorized by the U.S. Congress, would that newly issued debt be backed by the full faith and credit of the U.S. government? And we said, what's your opinion? And we had almost 1,000 responses to that over the last little while. 557 said yes, they thought it would be backed by the full faith and credit, but 430 said no, they thought it wouldn't. And so obviously, if we ever got into that situation, there would be a lot of confusion and uncertainty in the markets. I want to go to the left-hand side and focus on what we call here the emboldened regulators. And you know, for the first 4.5 years since the financial crisis, you know, the regulatory engine has certainly revved up, and you know, there are thousands and thousands and thousands of pages of new regulations that impact corporate treasurers, that we see in our consulting practice, financial institutions, whatever. But we've seen a sea change in the last couple of months where regulators have become even more emboldened. And I want to draw your attention to this because we at Treasury Strategy see our clients you know, threatened by what might be happening here. And 5 items that we'd like to mention very quickly. You know, the European Commission recently came out with proposed new money market fund regulations, which include a 3% capital buffer requirement that is widely acknowledged to be the death knell of European money market funds, and it seems as if the regulators ignored all of the comments that were submitted during the consultation period and are going forward and presenting the European Parliament with that particular proposal. That is harsh, draconian treatment, obviously, and you know, as we pointed out earlier, it's from the same organization whose reserve pattern seems to represent that of prime money market funds itself. A second emboldening factor. We at Treasury Strategies, we try to look for some of the early warning signals. And about a month ago, or several weeks ago, the U.S. Securities and Exchange Commission actually backed out of a tentative settlement with the reserve fund managers, and reserve fund shareholders. After the settlement had been announced, and the reserve fund shareholders would get their remaining assets returned, and the former manager would receive some penalties. And 2 weeks after that deal, the SEC has pulled back from that and is now looking for harsher penalties. Now, the upshot of that, of course, is that the reserve fund investors aren't getting their money back just yet. A third point we want to point out, and you're seeing this every day, are the fines that are being levied against financial institutions. And, before the financial crisis, if a financial institution received a fine of $5 million or 5 million euros, or, you name the currency, that was considered a huge fine. And then it moved to 50 million, and then 100 million was a big fine, and last year several hundred million was a big fine, and earlier this year $1 billion was a big fine, and now we're up into the Justice Department seeking an $11 billion settlement against J.P. Morgan. These numbers have exploded. And we think that's further evidence of an emboldening. Now, I want to give you two examples of regulators kind of extending their reach. You're all well aware of the money fund regulations. We've talked about those before. I mentioned the European Commission, but we also have the U.S. Securities and Exchange Commission trying to increase its regulation of U.S. money market funds. Well, lo and behold, last Monday, the U.S. Treasury issued a report pointing out the potential risks and hazards in the entire asset management industry. This particular white paper, which will certainly be the beginning of some potential regulatory steamroller, is looking particularly at the 10 largest companies offering mutual funds, not money market funds, but mutual funds or private separately managed accounts. And so apparently the entire asset management industry is now in the crosshairs. And just yesterday, the UK announced a new regulatory body called the Payment Systems Regulator. And this body is being established to regulate the payment system so that large banks can no longer unfairly price their services and keep out smaller banks. Not quite sure where all this is going, but I have to say, from our perspective and from the clients with whom we speak, both on the financial institution side and the corporate side, this is pretty chilling. Now, all this is an upshot of the financial crisis. We're not going to go into detail on this timeline. This will be in your deck, but we want to point out that this goes the whole ways back to June of 2007, when the asset-backed commercial paper market seized up, and then a series, a whole chain reaction began over that unfolded over the next 2-year period. And we highlight on the next page, the September through November period. Let's just point out that just in this week alone, we are marking the 5th anniversary of the second rescue of AIG, of the rescue of Wachovia Bank as it was merged into Wells Fargo, and the rescue of the Royal Bank of Scotland as the UK government made a massive investment. So that was quite a lot of stuff happening 5 years ago. We have a white paper called Dissecting the Financial Crisis, and if you're interested in receiving a copy, just drop us an email at info@treasurystrategies.com, and we'll be happy to send that to you. So with that, let me turn it back to Moni to introduce our AllStar panel here.
Yes, let me introduce the panel and we'll get into the panel, which we're excited about. So we have three panelists with us today. We have Martin O'Donovan, who is Deputy Policy and Technical Director at the Association of Corporate Treasurers, where his responsibilities include provision of technical guidance and regular updates to members, as well as representing the views of treasurers to government, regulators, and standard setters. The ACT is a professional treasury organization headquartered in the UK, but with members globally and delivering international qualifications globally. Debbie Cunningham is Executive Vice President, Senior Portfolio Manager, and Chief Investment Officer for Taxable Money Markets at Federated Investors, a leading investment management firm and pioneer in money market and fixed income funds. And we have Roger Merritt with us today, who is a Managing Director at Fitch Ratings in New York, a leading global provider of ratings, commentary, and research. Roger is responsible globally for ratings on funds and asset managers. So Tony, I'm going to turn this over to you to ask questions.
Well, thank you very much. Let's start first with Martin O'Donovan from the ACT. Yes, since we're now observing the 5th anniversary of the darkest days of the financial crisis, could you share with us how your business has changed, how your organization has changed over that time, and how some of your customers are doing things differently than they used to?
Yeah, certainly. First of all, I think it's interesting just to look at that timeline that you did. I mean, that's very revealing, isn't it? Certainly go back 5 years, and well, the whole system was falling to pieces when you see that list. I suppose, at the time, the big change for our members who tend to be working in industrial and commercial companies was the impact on the economy. As the economy takes a nosedive, clearly that feeds straight through into the cash flow within the business, which then becomes a big treasury issue. I guess, in the first few days or first period, if there is a downturn, you actually get this perverse effect that as you reduce inventories, actually it generates cash. You save cash to start with. But we saw a sort of massive downturn in the economies all around the globe, which fed through into cash flow problems, shall we say. But that, if you like, allowed Treasury professionals to come to the fore and say, well, look, how can we manage cash flow? How can we seek out pools of cash that are dotted around our group and manage that more efficiently? So that was one of the big game changers, that people put extra emphasis on that. Of course, at the same time, as was shown from that table and that timeline, the banks were beginning to feel very sorry for themselves, which of course meant they were lending less, and again, back to cash flow. Banks not being particularly healthy then made bank credit risk, one of the very dominant things that companies have had to think about. And although we've had regulation, things are improving, that's still a very real risk, and companies are very conscious of that. And if I may just sort of touch on, even now as we speak, the regulators are looking at how to remove that implied state guarantee or state support of the banking and the financial sector to make it clear that it's not there. And the proposals, therefore, are that if a problem starts to loom, you introduce this concept of bail-in, where the creditors of the bank, all the creditors of the bank, take some sort of write-down. Now, that might help save the bank, which in the end has to be good. But the thing that we've noticed is that there are a whole raft of secured creditors who probably rank ahead of people who've just got straightforward deposits or derivative exposures with the banks. So to some extent, the poor old corporate sector is left, as the creditor of last resort, which is a little bit of a scary proposition.
Boy, that sure is. Now, could we move to Debbie? And as you all know, Debbie Cunningham manages several $100 billion of short-term assets at Federated. Your life must have changed like 180 degrees.
Well, absolutely, Tony, that's the case. And you know, I'll mention a few of the negative aspects of it in the context of, you know, sort of the low rate environment and the impact that, you know, has had overall on the products that we offer, and overall from an economic perspective, the downturn and experience that, you know, has been the case not only in the U.S. but globally. And certainly, you know, the impact on a broader base from an industry standpoint with waivers and with, you know, sort of fee changes so that, you know, customers can receive some return. And when you compare, you know, sort of the other competitors in the marketplace in the context of bank deposits and, you know, direct securities, not much value in any of them at this point in time, and therefore, you know, going back to some of the things that Moni had quoted in the context of the survey results, you know, it's a very difficult time for managing large amounts of cash, despite the fact that those large amounts of cash, in fact, do exist. I'll emphasize a little bit more the positive aspects of it, because everybody that knows me knows that that's generally the mantra that we take forward. But I think probably the positive aspects that have come out of it from an industry standpoint for money funds are a little bit more conservatism with regard to liquidity. So certainly the changes that have been brought about with the 2010 amendments to Rule 2A7, you know, modestly changed credit profiles, modestly changed interest rate profiles, but very specifically changed requirements with regard to liquidity. And although funds were probably in the general ballpark that was, you know, then mandated with the 2010 amendments, it's now set in stone, and it's something that's, you know, viewable and monitorable on a regular basis. So I think that the liquidity around the funds themselves via the 2010 amendments is a huge positive in the marketplace. The other aspect, you know, that I would emphasize is disclosure and knowledge of the product from the underlying user's standpoint. Certainly, prior to, and I'd call this a 6-year anniversary rather than a 5-year anniversary, because, you know, it all started back with the SIV market in the summer of 2007. So, you know, I feel like we're in year 6, even though a lot of people reference the 5-year anniversary with the bankruptcy of Lehman being the focal point around that. But you know, over the course of you know, 7 or 8 years ago, you know, it was a question of what your yield was, not necessarily what was in the product. And therefore, when 2007 hit with the SIV problems in the marketplace, and then certainly the further implications of 2008, customers were scared, and I think to some degree that reflected in the cash flow that went out of the product for a period of time, because they didn't really know what they owned. There wasn't a lot of disclosure. There wasn't a lot of informational content about individual security holdings or sectors or types of securities, anything like that. And I think that's vastly improved at this point. We have products, as well as do others in the industry, that provide daily information, which I think, you know, in a money fund is probably a little bit overkill. Nonetheless, there are a few customers out there that want it, so we provide it to everybody in that context. Similar with, you know, mark-to-market verification of pricing. That's a disclosure item that historically wasn't out there. And, you know, if you look at today's sort of website information, from a federated perspective, we have what we call our Money Market Matter section, which didn't exist in 2007 and 2008. And effectively, once we get, you know, 5 or 10 questions about the same issue from a different group of clients, it's automatically a piece that we post in that particular section of the website. So I think information, knowledge of the product, and disclosure is a huge positive change in the time frame.
Fantastic. Thank you, Debbie. Now, Roger Merritt, I think Debbie set you up nicely. She talked about looking under the hood in the money market funds. That's precisely what you do. So how has that changed over the last 5 years?
You know, it's something we've always done. You know, whenever we rate a money fund, we require weekly surveillance from Debbie's firm and others who have rated money funds, and we take that responsibility very seriously. So we have analysts who are assigned to each and every fund, and whose job is to stay abreast of what's happening in the portfolios and to elevate, you know, anything they see as a potential issue. I think, you know, the the current political debate or in the impasse in Washington is a great example where we're really drilling very deeply into the money funds that we rate to understand what the implications are of a, while we don't, it's not something that we currently think will happen, but were there to be a restricted U.S. Debt default, we want to make sure we understand how money funds are positioning themselves, for such a scenario. So, and we actually put out a comment yesterday on that topic.
I was going to ask you, Roger. We want to go around the panel again and talk about the U.S. debt ceiling problem. So maybe we ought to start with you. What were some of the key takeaways that from the report you issued yesterday?
Yeah, sure. I think the key takeaways were that obviously money funds hold a large amount of exposure to either directly to U.S. Treasuries or indirectly via repurchase agreements that are collateralized by U.S. Treasuries. We estimate it's, at least in Fitch-rated funds, it's about $250 billion, or about 40% of total rated AUM. Our view is for the industry as a whole. We think the risks at this point seem to be manageable. The risk of a mark-to-market driven breaking of the buck, I think for most money funds seems to be low. And certainly I think a very important point for people to keep in mind, and Debbie could certainly speak to this better than I, is that under our rating criteria and under Rule 287 of the 40 Act, money funds wouldn't necessarily be required to sell T-bills that were in not paying due to some impasse in Washington. So, but that said, there are money funds, particularly government money funds, that because of their limited investment mandate, by charter, have to invest in U.S. government securities. So, those are the ones that we're particularly focused on in terms of understanding, how exposed are they to T-bills maturing in the next few weeks, starting next week and going into early November. What alternative sources of liquidity do they have in place to manage that? How exposed could they be to on an NAV basis to a large gapping of the rate on short-term T-bills, and just in general, how are their customers behaving? What's the level of redemption activity? Those are the things we're really focused on.
Roger, I think we might have done a better job of rearranging the speaker slide, and we should have a shot of you looking at Debbie, because that's kind of what you're doing. So Debbie, you're as close to the front line as you can get. You're on the front line. Can you respond to Roger's points?
Well, absolutely. Certainly, as we're speaking, Treasury Secretary Lew is speaking, and as we sort of understand about the remarks that we think are coming, and I've been on this call, so I don't know if that's in fact happening or not, but there's supposedly some temporary extension that's being undertaken, and Tony, you referenced this earlier in the call, and that's a good thing. That takes the pressure off of the bills, and Treasury securities that come due, and from what I understand, it would cover through the end of October and into the middle of November. The problem with that is we need Washington to get their act together. This is a temporary measure that obviously has caused distress in the securities marketplace. When you see 1-month Treasury bills that typically have been trading in the 0.5 to maybe 3.5 basis point range, gap out on a spread basis to 35 basis points, that's a dysfunctional market, and it's dysfunctional because of the dysfunctionality in Washington from a congressional perspective. And they need to get the two removed from each other. And I know the issue with, the debt limit, nobody's agreeing to the debt limit, not because they don't agree to the debt limit change, but because everything else keeps getting added into it. Healthcare gets added into it. Housing issues get added into it. And, they need to just look at it in the context of the debt limit itself and, sort of the disservice that they're doing to the country by continuing to put this in debate. So, going back to what Roger was talking about, they're looking at exposures in funds that will, be maturing over the course of the next couple weeks. Given that was sort of the consideration that we were looking at from a time frame perspective prior to Lew's testimony. However, most likely that is now going to be a longer time frame. Well, why do we have to keep modifying that? Why does that have to keep changing? I think, having the debt limit tied on a negotiation basis to anything else is just a wrong strategy. And certainly it's causing a lot of distrust and questions from an underlying shareholder perspective. They're not worried. I think ultimately the end result of the thousands of phone calls and the immense amounts of paperwork that we've been providing to clients in this regard over the last several days to several weeks, the end result is they're not worried, they're not moving, the cash flow from the fund hasn't changed at all. It's just an inordinate waste of time and efficiency to have to go through this process on a somewhat regular basis as we have been over the last couple of years.
Excellent. Now, Martin, from your perspective, the ACT has corporate treasurer memberships around the world, and now we've seen sovereign debt discussions move from Greece to Cyprus to the U.S. How does all that register with your members?
Well, I mean, it's certainly very worrying and damaging to the U.S. reputation, and as was just being said, you just think this is unnecessary. But I guess if you actually look at how this would flow through, the debt ceiling, as I understand it, means that the government can continue to make payments to the extent it's got revenue coming in day by day. And I guess the expectation is that they will favour making payments of interest in order to avoid a technical default. So, I mean, it doesn't actually solve the problem longer term, but in the short run, I suspect we won't reach a technical default. But really, as I say, what a way to run a country.
Absolutely. So, to everyone in our audience, we have the email addresses of Martin and Debbie and Roger. Feel free to contact them or share your ideas. And as Moni mentioned earlier, anything you share with us, we will pass out to the group. To summarize very briefly, as Treasury Strategies advises our corporate clients and our financial institution clients, we continue to see some key things. Information flows, which give you visibility of all of your cash and all of your securities, continues to remain, incredibly important. Treasury processes and procedures to make sure that everything is buttoned up. I think what we heard from our three panelists here is, we have no idea what the future is going to hold here because there are so many factors in play, but having the right technology and the organization and processes in place is certainly something that everyone ought to be doing right now. So with that, let me turn it back to Moni for a quick wrap-up, and thank you to everyone for tuning in.
Yeah, as Tony said, thank you for joining. And I think this is our 14th quarterly cash briefing. And a special thanks to our panel, Martin, Debbie, and Roger. Look for our invitation to the briefing next quarter. Also, for the corporates on the line, be on the lookout for our next survey and take a few minutes to complete it. Your input is very important to the ongoing assessment of trends and impacting cash levels. Thank you, too, for your questions. We will answer and circulate to all who registered, and we'll also send you a copy of the report. We encourage you to look at our sponsors' websites and on our website for further articles and commentary, and to reach out to us if we can help you with your liquidity, forecasting, or technology strategies as you navigate these uncertain times. Thank you.